Ladies and gentlemen, welcome to this tutorial on bond amortization using effective interest rate method. So here we have an example. ABC company issued 5-year 9% $100,000 bond at an 8% market rate of interest. The first thing we have to realize is that our bond is paying only 4.5% semi-annually compounded coupon payment, but the market wants only 8%. So our bond will be selling at a premium. And how do you find the present value of the bond is extremely simple. All you gotta do is do this present value here. What's the rate? Anytime we value bond, you have to use the market rate of interest. The market is saying that we need only 4% because it's semi-annual compounded here. It's 8% annually, so it's 4% semi-annual. And the number of periods we have is 10. The payment we are paying interest. The payment is 4,500. How did we get that? Because ABC company issued 5-year 9% coupon. So this 9% is our coupon payment. So we're paying every year $4,500, and that's how you get it. This is 4,500. And then at the end of year 10, here you see you have to pay back the face value, which is 100,000. Okay. All right. So So this is the present value of our bond. And what is this effective interest rate method is telling that you have to you have to amortize the interest payments. And when you receive this money, you put this in your balance sheet as an asset. Your asset goes up by this amount, 104. This is you receive from a company. And and at the same time, you have to pay interest because you're carrying this amount. You have to pay an interest, and you'll see that this amount will have to be multiplied by the market interest rate, which will give you the effective interest rate. So we have found out the present value of our bond, and our coupon payment is going to be 4,500 here, and we're going to be paying this throughout the years. That's because we have stated this in our debenture that we're going to be paying 4,500. But let's calculate our effective. Our effective interest payments will be the beginning book value or the carrying value. This is the amount we owed uh, times the market interest rate or the effective. What's that? That's 4%, right? Here you see that 8% divided by 2, that's 4%, semi-annual component. So here you have 4,162. So now this is the most important part where most students and even most people studying accounting and finance and economics that find difficult is understanding this next step, which I'll explain it to you. So this is our coupon payment. You're paying $4,500. You're paying this. Let me just format this. Okay, we're paying 4,500, but our interest payment, the expense, this is the expense we'll report on our net income. Or sorry, on our income statement. This is the interest expense that you're incurring for year one because we have a carrying value or we have a book value. We owe this is the amount we owe. So we have to pay interest. Nobody's going to lend you this amount of money for free over here. It's 104.55. So you have to pay an interest on that, and that interest is this. But what's happening is uh, we have to pay this less interest. But effectively, effectively what's happening is we are paying this 4,500, but our interest bill, our bill is only 4,162, but we are paying 4,500, so we're paying excess amount, and that excess is this minus this. Here you have 337. So that's the, so we pay this excess, so it's going to reduce our balance. It's going to reduce our balance. You see this? You saw that this is reducing our balance because we're paying extra. So our book value is now 103,717 dollars. Our book value is this. So if we sell this in the market, we're going to get this much for our bonds. And at the year two, what's happening is our interest payment is going to be the book value from the beginning or end of year one times the interest payment, which is 4%. Again, we got to pay 4% interest. That's our effective cost. Okay, let me write this for you. This is our effective interest cost. Okay, and I'll highlight this. This is the most important part. If you didn't get this, you are in trouble. So this is what you have to understand. So once again, here you see we are paying 4,500, but our interest bill is only 4,148. So we paid extra. So here we have this minus this. So now our carrying value is going to be uh, it's going to go down because we only owe this. And let's drag this and see some interesting results that we have. Now let's discuss what we have over here. Let me highlight this. What happened? Okay. So at the end of year 10, this comes off the book. This was in our balance sheet as an asset. Now this comes off the book. That's because we're gonna pay back the amount, and we received $104. We borrowed this, and we paid some interest on this. And at the end of year 10, we have to pay back our lenders. So we paid back to them for this. And the next interesting thing is, what if you add these? Let's see what happens. You have some amount over here. Let's see what the amount is. So you have 4,505. So this is equals to this minus. Both of them are equal. And I'll show you in the next video what this is effectively saying. Thank you for watching.